Buying a home is a big financial step, and most people rely on a mortgage to make it happen. But did you know there are first and second mortgages? What is the difference and which one is right for you? Let's break it down. A first mortgage is the primary loan you take out to purchase a home. It is typically the largest loan on the property and it has the first claim on the home if a borrower defaults. This means if the home is sold, the first mortgage lender gets paid first. Some common first mortgage lenders in Canada include traditional banks like RBC, TD Canada Trust, Scotiabank, and CIBC, as well as credit unions such as Coast Capital and Radian. Online lenders like True North Mortgage also offer competitive mortgage options. These lenders provide various loan products including fixed rate and variable rate mortgages. For example, let's say you're buying a home for $600,000 and secure a first mortgage of $480,000. With a 5% interest rate on a 25-year term, your monthly payment would be approximately $2,800. However, these numbers can vary depending upon the lender, credit score, and the loan type. So now the question comes to, what is a second mortgage? A second mortgage is an additional loan taken against the home's equity. This can come in two forms: a home equity loan or a home equity line of credit, also known as a HELOC. It allows homeowners to access cash while still paying off their first mortgage. Second mortgage lenders in Canada include major banks like Scotiabank, TD, and BMO, as well as credit unions and private lenders. Companies like Home Trust, Equitable Bank, and certain mortgage investment corporations specialize in second mortgages, offering flexible terms for homeowners who need additional funds. These loans are often used for home renovations, debt consolidation, or major expenses. For instance, you have a home and it's valued at $600,000 and you have built up $200,000 in equity. You may qualify for a second mortgage of $100,000. Depending upon your lender, this could be issued as a lump sum amount or a revolving HELOC, where you can only pay interest on what you borrow. So when should you consider a second mortgage? A second mortgage can be a smart financial tool when used for the right reasons. Here are some common situations where homeowners consider a second mortgage. Number 1 is debt consolidation. If you have high interest debts such as credit cards or personal loans with rates over 18%, using a second mortgage with a lower interest rate, which typically is between 8 to 15%, can help you consolidate your debt and reduce your monthly payments. Number 2, for home renovations. A second mortgage can help fund major home improvements like upgrading your kitchen, adding a rental suite, or renovating your basement. These upgrades can increase your home's value and improve your living space. Number 3, starting a business. If you're launching a business and need startup capital, a second mortgage can provide funding without taking out a high interest business loan. However, it is important to have a solid business plan to ensure you can handle the added debt. Number 4, educational expenses. Some homeowners use a second mortgage to finance their child's university education, as it may have lower interest rate compared to student loans or personal loans. Number 5, investment opportunities. Some homeowners use home equity to invest in real estate or other ventures. While this can generate returns, it also carries risk, so careful financial planning is essential. Number 6, rebuilding credit. If you have fallen behind on payments and your credit score has suffered, a second mortgage can help you consolidate debts and get back on track. By making consistent one-time payments, you can gradually improve your credit score. So how do they compare? First mortgages usually have lower interest rates since they are the primary loan. Second mortgages, however, come with higher rates, but they are riskier for lenders. If a borrower defaults, the first mortgage lender is paid first. leaving the second mortgage lender at a greater risk. For example, in Canada, a first mortgage might have an interest rate of 4 to 6%, while a second mortgage could range from 8 to 15% or higher, depending upon the credit score and lender policies. HELOCs often have variable rates tied to the prime rate, making them more flexible but also subject to fluctuations. Another key difference is the repayment structure. First mortgages are typically paid in fixed installments over 25 to 30 years. In contrast, second mortgages often have shorter repayment terms, sometimes as little as 5 years, requiring higher monthly payments. First mortgages help you buy a home with better interest rates, but they require a significant down payment and credit approval. Second mortgages can provide extra funds for renovations, debt consolidation, or investments, but they add to your debt load and come with higher interest rates. For instance, if you bought a home of $600,000 with a first mortgage of $480,000 and later took out a second mortgage of $100,000 to renovate your basement, your total mortgage debt would now be $580,000. This means higher monthly payments and additional financial responsibility. However, when used wisely, a second mortgage can provide peace of mind. It allows you to manage financial obligations, access needed funds, and avoid high interest debt, giving you a greater control over your financial future. Understanding the difference between a first and a second mortgage can help you make smarter financial choices. If you are considering either option, be sure to compare the lenders, interest rates, and terms to find the best fit for your needs. Need help deciding which is best for you? Let us know in the comments, and don't forget to like, subscribe, and turn on notifications for more mortgage tips.